Dennis Rodman is in the Hall of Fame, Basketball Hall of Fame, and he's the lowest scoring member of the Basketball Hall of Fame. And there was actually a controversy about whether he should even be included in the Hall of Fame. He scored like 6 points a game or something like that. If you had a team full of Dennis Rodmans, if you had 5 Dennis Rodmans on a team, it would be the worst team in basketball, right? Because it can't score. But Dennis Rodman can rebound and he can pass. So what happens is if you take Dennis Rodman and add him to a team of 4 people that can score, the team gets much, much better, right? And that's really what gold is about. If you had a portfolio that was just gold, I mean, you said gold did really well in the 70s, but also gold, kind of like real estate, has gone up 4% a year since, the 1930s. So, if you had a portfolio that was just gold, it would not be very exciting. When you take gold and you add it to a bunch of other stuff, that's when things get better.
All right. Welcome to another edition of Resolve Riffs. Today we've got a very special guest, freshly minted new author of the book No Worries: How to Live a Stress-Free Financial Advice, Jared Dillian. Also the editor of the Daily Dirtnap, a fantastic newsletter for, I think, a lot of out of the box thinking, and has been continuously in publication since 2008. Jared, welcome to Resolve Riffs. I'm sure there'll be lots of our listeners who will be pleased and excited to hear what you have to say, both on taking the stress out of money and what your current macro views are on, the current machinations around the world with respect to monetary policy, hard assets, and all of those types of things. So, welcome to the show.
Hey, thanks for having me.
We should mention it's this is not Jared, your first novel, right? You've got a few other novels under your belt. What are they?
Well, the first book was a memoir. It was called Street Freak: Money and Madness at Lehman Brothers, and that was in 2011. And then in 2016, I published a novel called All the Evil of This World. 2023, I published an essay collection called Those Bastards. And then No Worries in 2024, and I have a short story collection coming out later this year.
Oh wow, that's kind of cool.
Yeah.
So I think Mike and I lived through many of the same formative milestones of the journey that probably motivated the writing of your first three books. Maybe not your exact experience with Lehman Brothers, but the decisions made post Lehman Brothers and the constant creep of supervision, regulation, intervention in markets, making markets less and less um, free to act on, as a price setting mechanism and more as a policy mechanism for various government objectives. Um, but this latest book is quite a departure from those themes. At least that's my sense. If so, what motivated that shift in interest or curiosity, that thread that you wanted to pull?
Well, I really wanted to write a book about personal finance. Around 2018, I started reading all the classics, right? So Rich Dad, Poor Dad, and The Millionaire Next Door, and the Dave Ramsey book. And I read all those. And I kind of came to the conclusion that the advice that people were getting, average people were getting from these personal finance gurus was pretty terrible. Um, and at the time, I had a radio show. I actually had a radio show on personal finance that was not a big show, but I was on every night for 2 hours, and the themes I kept coming back to was this idea of financial stress and how to minimize it. And a lot of the advice that people are given may help them get more money in the long run, but it does at a cost, and that cost is your sanity. So really the two sources of financial stress are debt and risk. So the idea is you want to minimize your debt and minimize your risk to the best extent that you can, and then you can be happy with your financial situation.
Is
Okay,
there any
gotcha.
yeah. Is there anything in particular that really bothers you about the current state of advice going on? Any particular examples that are get under your skin?
Well, a lot of it focuses on um, cutting expenses. This obsessive focus on cutting small expenses. And the classic example that everybody knows because Susie Orman talked about it is buying coffee at Starbucks. Right? She says if you buy coffee at Starbucks, it is like peeing $1 million down the drain. Right? Because if you saved $4 every day for the next 40 years and you invested it, you could have $100,000 or whatever. So stop drinking coffee. And what I found was, if you do the math on it, it really doesn't make a lot of sense. Um, Through one decision, like buying a house, if you get a house that's 500 square feet smaller and is correspondingly cheaper, then you're paying a lot less in interest over the life of the mortgage, and it ends up being way more money than what you might have saved by not buying coffee. So, it's really the goal is to focus on the big things and not the little things. The little things don't matter, the big things matter.
It reminds me a little bit of the willpower, sort of some of the books on willpower where you have these small things that you're gonna deprive yourself on a regular basis, but they chip away at the ability for you to actually stick to that sort of stuff. So you end up failing on the small stuff, and if you're not making the big decisions right in the first place, then it's kind of total catastrophic failure across the board. And I guess your point is get these pillars correct, get the house right, get the student debt right, figure out how to get a car properly, use credit cards in a smart way. And then the little stuff, enjoy your life, I guess, is kind of the
Well, the reason why that fails is because human beings can give up large luxuries, but they can't give up small luxuries, right? Like you can live in a slightly smaller house and you're not like this house sucks, I hate it, I can't wait to move out of here. It doesn't really matter. You're sitting in the living room watching TV anyway. Like you can give up a slightly larger house, but you can't give up coffee every day. It's these small luxuries that we need and they don't cost a lot of money. And like I said, people can give up large luxuries, but they can't give up small luxuries.
and I guess
A
those
lot
those
of the
small sorry, go ahead, Adam.
No, it's cool. I was gonna say, so much of the cost of a home is not so much related to square footage as it is to time of travel, right? Like, you want to live within a certain time of travel to to work, for example, right? And there's sort of a minimum amount of space that a new family, for example, can use to approximate some kind of middle class lifestyle, whatever that means these days. Um, so I'm just wondering how you trade off because that time factor is to my mind quite different than the space factor, right? Because that time factor is something that you'll just never get back. You spend an extra 20 minutes in the car every day, um, versus spending a little more to live a little closer to work. But all those homes are owned by people who bought them 30 or 40 years ago. How do you how do you try to factor that into the home buying equation?
Well, time is super important. The interesting thing is that in about 2 weeks, I'm moving into a house that I built, and the house has a dedicated office space, and I'm gonna be working from home, so my commute goes to 0, right? My wife's commute gets longer. She has about a 45-minute commute right now, which is gonna turn into an hour, but she only has to go into work, like, 2 or 3 days a week, so it's not that big of a deal. But like you said, like, time is super important. So, I know I never really understood these people who lived in, like, Easton, Pennsylvania and commuted all the way to New York City every day, like, 2 hours each way. Like, I mean, yes, you can be productive on the bus and you have a laptop and you can read books and stuff like that, but that's a colossal waste of time.
Yeah, I guess agree. I guess my point was or question was sort of how you would advise thinking through this issue. Because I think, the size of a house has, um, to my observation, kind of largely become secondary to the time that you get to spend with family or doing things that you like rather than commuting, right? And that, as a function of that, the cost of time ends up being the limiting factor, not the cost of more housing space.
Yeah, and I think people tend to undervalue time, with respect to money. I think they put a higher value on money and less value on time when it should be the other way around. It should be the other way around. So,
Yeah,
Yeah.
no, I agree. And obviously, working from home is a growing trend, or I guess it's probably in the middle of finding some kind of equilibrium. But at the margin, it seems like this is a growing trend, and that trade off will become less and less important over the next few years.
yeah.
The other thing you mentioned in the book too is as you have debt to, pay it down quickly, which is interesting. I don't know if you guys ever, heard about the when interest rates got to that sort of zero bound and stayed there for such a long time. Something I heard from the younger generation was, why would I ever pay off my mortgage? Right? This idea that I'm always going to have it anyway, and the management of that is so it's at such a low rate and so manageable. I'll just lever up continually. And, that as someone who, witnessed a little bit of the '70s at the tail end and can remember that in some of the '80s and early '90s in Canada, that's kind of a head scratcher. People just didn't have the experience of having a period of time where interest rates ratchet up quickly, which they have. So maybe this is less of a lesson today than it was back then. But walk us through some of the thoughts on debt and how you think the perception of debt over time has changed.
Well, pretend you had a mortgage with a 0% interest rate, okay? So you were just making principal payments. You can still default on that mortgage. Like, you can still default on it and lose the house,
Hmm.
okay? So, the value in paying off a mortgage is to reduce your stress. Now, I paid off a couple of mortgages in my lifetime, and I can tell you that when you own a house free and clear, it reduces your stress massively. If you own your house free and clear, there is you are untouchable. You are in an unassailable financial position. It really, no matter what happens to you, you have a place to live. Nobody can take the house away from you. So, I say in the book that everybody should strive to pay down their mortgage in 10 years at a minimum. My last mortgage, I paid off in 3.5 years, right? Now, the other part of that is that was a 3.75% mortgage. So you say, well, why did you pay it off in 3.5 years? Well, you know, basically, after I paid it off, I added up all the interest I paid in 3.5 years, and it was $70,000. And I said to myself, what could I have done with that $70,000 aside from paying it to the bank? Like, interest is the worst thing in the world because you get no enjoyment out of it. Is paying interest fun? Do you get some utility out of it? It's basically all you're doing is contributing to bank profits. And one of the things I say in the book is you never want to be a good customer of the bank. And a good customer of the bank is somebody who makes the minimum payment every month, pays the maximum amount of interest, never prepays, and that's a good customer of the bank. So, I never do that.
Right. Okay. So part
Understood.
of your, how to thoughtfully buy a home is to buy a home that you have a good shot at paying off aggressively or on aggressive time scale, right? You've got a few other points in the book about, a lot of people don't make thoughtful decisions in how they buy a home. What are some other elements that people often miss?
Well, buying a house for a lot of people is an emotional decision, right? Like, they see a house or, they get a realtor and the realtor shows them a bunch of houses and they fall in love with one. They say, "Oh my god, we have to live here," right? The kids can play in the yard and we can put the TV here and bedrooms over here and they see themselves in the house, then they have to have the house and then it becomes an emotional decision. I would say 95% of home buying, really, unless you're an investor, is an emotional decision. Once you've decided you want the house, you have to have the house, and
Really?
then you're willing to overpay for it. And that's what happens to the vast majority of people. You have to separate the emotions from buying a house. It has to be just a rational decision.
One of the things that, because I mean, that just seems to make a ton of sense to me. And I've always embraced the idea of trying to pay off a mortgage as quickly as possible, even during the low rate period. Um, but that seems to have just flown out the window. And part of the reason that that has, people almost laugh at that idea now is that it has paid so handsomely to be imprudent over the last 10 years, right? I mean, the smartest thing in retrospect you could have done 10 or 15 years ago is buy a home vastly outside of your affordability range, continue to ratchet down the interest rate that you pay on that loan as the Fed and other factors lowered rates. And of course, as a function of the fact that people began to think about home prices in terms of not the cost of the home, but the monthly payment on a home, the, the prices of homes went up commensurately over that time and made everybody who decided to be over leveraged and buy too much home very rich. Right? So how do you counter this experience? I mean, I struggle with this from a very frustrating perspective all the time, and I'm wondering how you position it in the book so that it connects to people who obviously have had a very different experience with prudence and imprudence over the last 10, 15 years.
Well, I didn't talk about this in the book, but interest rates are basically a signal. Okay. And when interest rates are low, they're telling you to borrow money and buy assets. And when interest rates are high, they're telling you to sell assets and raise cash, right? And now interest rates are high, so the calculus is completely different. I will say that the housing market is still pretty strong, at least in the US for demographic reasons. You have a huge population bulge, the millennials that are just starting to buy houses. And we also had 10 million people come across the border, which are going to need a place to live. So, I think housing prices over the next 10 years in the US are going to do what they did in Canada from 2013 to the present. So, I think they're going to go parabolic here. I think it's going to be crazy. So,
So then, how do you advise a the young person now? You say, look, get in now, or doesn't really, yeah, they're vastly overpriced already, but they're never going to get cheaper. So just be prepared to have far less disposable income than your parents had because, you're going to have to spend a lot more on your home.
yeah, I mean, that's an economic forecast, and there are no economic forecasts in the book. I didn't the you never wanna put a forecast in a book, right? Because
Yeah.
it's gonna turn out to be wrong, and then you're gonna look stupid, right? So I didn't make any forward-looking statements on what the housing market's gonna do over the next 10 years. But, usually the housing market is not doesn't really provide a great return. Like if you look over the last 100 years, housing has returned about 4% a year, which barely beats inflation. Having said that, even though it hasn't been a great investment for a lot of people, it is a great investment because a lot of people don't have the ability to save and invest. They can't put money in a bank account. They can't buy stocks. They can't buy mutual funds. But what they can do is pay off a mortgage, right? And build equity over time. There's a lot of people in this country who have, they bought a house for $70,000 in 1979, and in 2024 they sold it for $900,000, and the mortgage was paid off and they had 100% equity, and they take that money and they move to a place like South Carolina and they buy a house for $250,000 and they just live off the rest in retirement. Like that story happens over and over again. And these are people who never bought a stock, bought a mutual fund or anything. They were able to pay off a mortgage over time and build equity.
Yeah. I guess the question is, how do you how would you advise millennials at the moment who are, as you say, at the point in their lives when they do want to start a family? For many, the biological clock is ticking, um, but they're faced with a housing market that is going from strength to strength. They started from very expensive. Interest rates have risen, so the monthly payment now is even twice what it was 3 years ago. Um, I'm just wondering your thoughts on it because I personally struggle with what the advice should be.
Yeah, it's a hard decision. I mean, look, it's also an asset allocation decision. You want to have some money in stocks, you want to have some money in bonds, you want to have some money in cash, you want to have some money in commodities. You also want to have some money in real estate. And if you're renting, I mean, there's nothing wrong with renting, but what that means is you don't have any exposure to real estate as an asset class. So, if real estate as an asset class does really, really well, and you own stocks and bonds which don't do very well, then you're missing out. You're missing out on that diversification. So, since you can't predict the future, you basically want to own a little bit of every asset class, which means you're probably going to have to buy a house. And the only advice in the book that I give is that your housing costs should be less than 25% of your income, which is difficult to achieve, but that's the goal that you should shoot for. So your mortgage, your HOA fees, your property taxes, your insurance should be 25% of your income.
All right, which basically I think for the top dozen major employment centers in the US means that your average millennial family is living about 90 minutes one way to the office if they have a commute.
Yeah, yeah, pretty much. Yeah. I mean, you could stretch it a little bit. You can do 30% of your income, but what a lot of people do is, if you live in San Francisco, then it's 50% of your income. And that crowds out your ability to save or even spend money on fun stuff, right? So, look, it's a balance. Like, these are hard choices.
Yeah.
Trade-offs, trade-offs, and trade-offs.
Yep, for sure. Um,
Well,
Go
yeah, I
ahead.
guess yeah, those are sources of the financial stress you talk about, and you have 2 sources of that you talk about in the book. You wanna elaborate on that a little bit more because 'Cause you're beating around the bush a little bit, but, you wanna lay them out distinctly?
So the two sources of financial stress are debt and risk. And we've spent a lot of time talking about debt as it comes to housing. Risk is the investment side, financial markets risk. And, the conventional wisdom in investing is that you should put all your money in the S&P 500 index fund. And why should you do that? Because it returns the most. You should put your money in the thing that returns the most. Well, if something has a good return, it probably also has a lot of risk. And if you invest in an index, you get the returns in the index, but you also get the volatility of the index. And the S&P 500 is pretty volatile. It moves around a lot, about 1% a day, 15 to 20% a year. And over the course of an investing lifetime, there's going to be one year when it's down 50%. It's just going to happen. So, I don't think that's very good advice. Because number one, it causes people a lot of stress, right? Number two, they may not be able to withstand that stress and they may liquidate their investments at the worst possible time. So the goal is to be in some kind of vehicle which gives you a good return, but cut your volatility in half.
And then how did you approach that in the sleep at night portfolio that, you talked about in the book?
Yeah, I call it the awesome
The
portfolio,
awesome
and
portfolio.
that's 20% stocks, bonds, cash, gold, and real estate. And this portfolio, which we back tested back to 1971, Um, this has returned 8.1% a year for the last 53 years with half the volatility of an 80/20 portfolio. And the worst drawdown in any year was 12.2%. So you say, look, like I'm getting 1% less than the stock market with half the volatility. And the worst year that I can possibly have is down 12%. And by the way, in the year of the financial crisis, it was down 9% when the broad market was down 38%. So even during the financial crisis, you were protected. So this is the solution.
So it's that old adage of diversification. And then How do you, one of the so we're large proponents, big proponents of diversification. One of the challenges is the tracking error that comes with, you know, having everybody else in your friend group who are in the S&P and having the best of times at times and the worst of times at times, and you're not in that emotional roller coaster. Do you have any thoughts on that side of the equation?
Yeah, I mean, this also takes some intestinal fortitude because 42% of the time you are going to underperform the S&P by 10%. 21% of the time you are going to outperform the S&P by 10%. As it turns out, the times when you're outperforming the
Yeah.
S&P, you do it by a lot more than when you underperform. But 42% of the time, you're gonna be talking to people at cocktail parties, and they're gonna be bragging about how the market is up 30% this year, and you're gonna be up 11%, and you're gonna be like, "Why am I in this stupid portfolio?" Everybody else is getting rich but me. But in the bad times is when it has real value.
Yeah,
Yeah,
and
that makes sense.
a lot of people have forgotten that 2000 to 2014 run in the S&P where you get 50% declines in the market and 0 returns for, better part of 12 to 14 years. So stocks are risky and they are a certain regime. Now that might move us into, the area of gold. I know, Adam, you found a wonderful market carpet that showed the top asset classes. I forget who published, Bank of America maybe, and, gold, 7 out of the 10 years in the '70s was the top performing asset class, and not by a little, by a lot. I know you're a proponent of gold, Jared, but, can we walk through a little bit of the value of having these different pistons in the engine of the awesome portfolio versus, just betting on, stocks and sort of one regime all the time?
Well, a lot of people, people who have an index fund, they say, "Well, I am diversified because I have 500 stocks. I'm diversified." Well, I don't consider that to be diversification at all because stocks are highly correlated to one another, right? So you have this big basket of highly correlated stuff, and they say, "Well, I'm gonna add some bonds." Okay. Well, there's long periods of time where bonds are actually positively correlated to stocks. We saw that in 2022. So basically, what you have is if you have stocks and bonds, a 60/40 portfolio, you have this basket of financial assets, but you don't have any real assets. And once you start adding real assets like gold, commodities, real estate, that's when the benefits of diversification really kick in, right? And particularly gold. The most special thing about gold is its diversification qualities because it is it is very little correlated to anything else, and those correlations are not stable, they change over time. So it is the perfect diversifier to any portfolio. Once you add gold to a portfolio, the volatility immediately comes down. That's what makes it so useful.
Yeah, and I think you've made some analogies in the past with the Dennis Rodman analogy, which I think it bears repeating because it's a great illustrative story on the power of diversification, via a different avenue than just scoring all the time, if you will. Maybe you can, walk us through that.
Yeah, well, Dennis Rodman is in the Hall of Fame, Basketball Hall of Fame, and he's the lowest scoring member of the Basketball Hall of Fame, and there was actually a controversy about whether he should even be included in the Hall of Fame. He scored like 6 points a game or something like that. If you had a team full of Dennis Rodmans, if you had 5 Dennis Rodmans on a team, it would be the worst team in basketball, right? Because it can't score. But Dennis Rodman can rebound and he can pass. So what happens is if you take Dennis Rodman and add him to a team of 4 people that can score, the team gets much, much better, right? And that's really what gold is about. If you had a portfolio that was just gold, I mean, you said gold did really well in the 70s, but also gold, kind of like real estate, has gone up 4% a year since, the 1930s. So, if you had a portfolio that was just gold, it would not be very exciting. When you take gold and you add it to a bunch of other stuff, that's when things get better.
What does gold respond to that makes it so different from stocks and bonds?
Nobody knows. Nobody knows. Seriously. I mean, gold responds to a bunch of different things. I mean, theoretically inflation, but not really. Lately, geopolitical risk, but not really. The thing that it has the highest correlation to is budget deficits. That is the one thing that it has the highest correlation to is budget deficits over time.
Right. So the idea being that governments have a really hard time scaling back spending. Eventually, it becomes very hard to fund deficits through tax receipts because of the crowding out effect or what have you. And um, they become more and more incentivized to monetize some of that debt. And then because the amount of currency outstanding or dollars outstanding, say, relative to a fixed amount of gold, which really doesn't change much from year to year. They don't mine hardly any of it out of the ground. Um, then, over time, it's not that gold so much is rising as as other stores of wealth are falling, right? And gold stands out from that perspective. That might be one narrative that helps explain why it's a nice diversifier against stocks and bonds.
Yeah, that's right. I actually had a tweet thread about that a couple of weeks ago that was pretty popular. That's the exact concept that I was talking about. So,
Gotcha. And then real estate, typically people own real estate with quite a bit of leverage, right? Because they're buying it um, with a mortgage, right? I mean, obviously, if they pay it down really quickly, then that leverage factor declines commensurately. But for many years, they end up with this like highly levered bet on real estate, and obviously, equities are much more risky than bonds are, right? Any thought to the fact that you've got different types of assets which are diverse in their nature and what drives them from day to day and week to week and month to month, but they have very different risk profiles, and that a lot of the time, levered real estate or uh, the equity side of the basket will dominate what happens in the portfolio, and the diversification opportunity from stuff like bonds and cash are they don't really have a chance to shine through.
well, I mean, the funny thing is that that 12.2% drawdown that I talked about in the awesome portfolio, that actually happened in 2022. That was the worst year for the awesome portfolio. Stocks were down, bonds were down, real estate was unch. You started to earn more money on cash, and it was also a pretty bad year for gold too.
Right.
Um, so that the one vulnerability to any kind of diversification is rapidly rising interest rates. In a period of rapidly rising interest rates, really the only place to hide is cash. The only place to hide is cash. So that actually might happen again. That could be 2025 or 2026. It's possible that interest rates could go up a lot more and we go through that again. Um, so yeah, I mean, in times when interest rates go up a lot, then everything becomes correlated to the downside. So
Right. So let's discuss some themes here. I mean, you mentioned that we could see another inflation push over the next couple of years or so. Um, what might drive that in your view? And then we'll also sort of move around a little bit into some of the other themes you're watching.
well, I mean, really, inflation is, as Milton Friedman said, a monetary phenomenon, but it's also a psychological phenomenon. And for years, even though the Fed was printing a lot of money, we had a disinflationary psychology. People did not expect price rises. This is how people behave. If you think that prices are going to rise, then you act in such a way to make prices rise, right? So let's say you're going to go to Home Depot and you're going to buy a bag of fertilizer and it costs like $8. And you get to Home Depot and you're like, well, we have inflation and I don't know what this bag of fertilizer is going to cost a year from now, and I might need some more. So instead of buying one, I'm going to buy 10 and I'm just going to keep them in my basement. And the act of me buying 10 and everybody else buying 10 pushes up the cost of fertilizer. It accelerates economic activity, right? So even though inflation has come down from the highs, which were about 9%, and now we're at 3.5, we still have an inflationary psychology, which I'm sure you would agree with. People are expecting prices to go higher, right? If you go back to the late 70s, early 80s when Paul Volcker was chairman, the thing that he did that was so special was he raised interest rates so much and so fast that it broke that inflationary psychology, right? And we haven't done that yet. And if you go back to the 70s and if you look, there were really 3 waves of inflation. In 1969, you had a bump of inflation to about 4 or 5%. Then in 1973, 74 went up to about 8 or 9%. And then in 1979, it went up to like 14%. So we are currently we just passed the second wave of inflation. And I think that we are going to get another one that is bigger than the previous one. So, because we did not break that inflationary psychology, and this is going to continue until we do.
Right. And what would be some signs that we were beginning to break that inflationary psychology? Do we need a major uptick in unemployment or a major fall in prices, say in equity prices or in aggregate prices, in order to believe that cycle may be over?
You need all those things, but interestingly, one big component of inflation is regulation, right? And regulation is known as inflation by fiat. So if you regulate an industry, you impose costs on it, and the industry has to raise prices in order to cover those costs. So if you have a period of time where you have increasing regulation that increase costs, and what you another thing that you saw correspondingly in the late 70s and early 80s was a big wave of deregulation. We saw that in the airlines, we saw that in a lot of industries, and prices dropped a lot, and it was actually because of deregulation. So that's a big part of it.
Gotcha. And we don't seem to be in a cycle where the government is hurrying to get out of the way. They
No.
seem to be moving steadfastly in the opposite direction.
No, and if we did, if the government did get out of the way and started a wave of deregulation, you would wanna buy bonds until your head caves in. So,
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting edge, globally diversified, and systematic investment strategies that are designed to be broadly non correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorsolve.com. Now back to the podcast.
What are some of the other themes that you're watching though?
well, gold for sure. Private equity is probably the biggest one I'm focused on at the moment. I am of the belief that we have a private equity bubble. So I saw an article today that private equity is going to be buying NFL teams. They've already bought minor league baseball teams, but they've been buying dental practices and pizza parlors and car washes and um, the funny thing about finance is that somebody comes up with a good idea and implements it and they make money, and then it turns into monkey see, monkey do, and everybody is doing it. We have 17,000 private equity firms in the United States. And this all made sense when, interest rates were 0 and you could buy a business for 4 or 5 times multiples. But now interest rates are 5% and you're buying businesses at 10 or 12 times multiples. Like, this is not gonna end well, and it's gonna have systemic effects. It's gonna crash. It's gonna be a problem. So,
Yeah, the other thing that happens when private equity gets involved is that And it's this weird cycle where, so much of private equity is investors are pension funds and sovereign wealth funds and endowments. And so you've got these, pension funds who are acting on behalf of their stakeholders, ex-employees of a company or, but just your average everyday citizens, and this is their retirement savings. And you give the money to private equity and they go out and they buy homes and they go out and they buy gas stations and they buy dental practices and they buy health insurance providers, et cetera, et cetera. And then they proceed to make the margins in all of those different businesses much wider. The cut the customer service out in order to get those wider margins. And these are all relatively essential services to the very people that are funding these private equity investments via their pension contributions, and it just goes round and around and makes everybody's life worse.
Well, I can tell you that at, pension funds and endowments, places like CalPERS, like, the goal in those places is to avoid accountability. Those decisions are being made by committees of lots of different people, and, everybody, the goal is to, um prevent embarrassment, so people do what is popular or fashionable. So, CalPERS actually just put another 34 billion into private equity, on the highs. So, yeah.
Wow.
Might be a good segue into, we touched on it a little bit earlier, but Mike and I, and well, we have just in general on this podcast and at Resolve and of the view that benchmarking in general is one of the most insidiously evil pursuits that seem to be absolutely pervasive in the investment management industry. Um, any thoughts on benchmarking in general? I mean, obviously, benchmarking is driving the phenomenon that you're describing in private equity, but it kind of drives a lot of those, in the end, very bad investments, right?
Well, what do you mean by benchmarking? I don't understand.
Just like having a policy portfolio, making sure that your policy portfolio is close to the other policy portfolios or asset allocation mixes of your peer group, and then being held accountable not to whether that asset allocation actually makes sense or is aligned with the objectives of your stakeholders, but using that benchmark allocation or the underlying equity benchmarks within the equity sleeve of the policy portfolio or the bond benchmark within that bond sleeve as an end in itself.
Well, look, I think about things in terms of absolute return and not relative return. You know, like the mutual fund world is very weird to me. If you have a small cap manager, and they lose 15% in a year and the index is down 20%, then they're thrilled, right? Like they're happy. And I'm like, guys, you lost money. Like that, like I don't get it. Um, so I've always been, of the absolute return mindset. I don't really understand that at all. So,
Yeah, I mean, the strange thing about that example is that if the small cap manager who, 95% of people who allocated to that small cap manager wanted that manager to be down just slightly less than the small cap index. And if the manager had too much tracking error to that index and did wildly differently, but even in a good way in that year, many allocators would be pulling money from that
yeah,
manager,
absolutely.
right?
Yeah. Yeah.
Yeah.
Yeah.
That's the insidiously strange and evil dimension, or one of them anyways, of this obsession with benchmarking.
Yeah.
It really makes no sense.
So what do you also let's expand we gold obviously you're a big proponent of gold both as a long-term diversifier as well as potentially a short-term opportunity. I think you're on sort of record for that. Anything you want to add there? And I'd like to broaden the gold discussion out to commodities more generally. If you're seeing things in the energy space that are particularly interesting and how you're interpreting, the impact of oil and the oil shocks might have on your current global macro thesis.
Gosh, I don't have a global macro thesis. I'm just a trader. I just um no, I mean, I would just say that commodities broadly have you probably seen that chart of commodities relative to financial assets over like the last 15 years or something like that. And like financial assets were very expensive and commodities were very cheap, and that chart was on the lows, and now it's starting to tick up again, right?
Yeah.
So, if we really do have an inflationary environment, which I think we will over the next couple of years, um, commodities are going to outperform, and they're starting to. Gold and copper for sure. Oil has come up a lot. The one thing that really has we've seen cocoa and orange juice obviously have exploded. Some of the soft
Mhm.
commodities, coffee has gone up a lot. The one thing that really hasn't gone up is agriculture, which is kind of a function of climate change, which has been beneficial for agriculture production and also crop yields and stuff like that. So, but yeah, commodities have come up a lot, and I expect them to come up even more. So,
And then, yeah, so this idea of diversity as well. I think, there's been a few folks out there talking about, for example, the S&P 500, 500 stocks, but 4% is designated, 4.5% designated to sort of the energy sector and another 2% to the material sector. And so if you're thinking that your stock portfolio has any hedge to energy prices, it's really not true. I mean, you have to go back to 2008 when, the exposure to the energy sector was up in the 16% range. At least then you had some exposure. Today's exposure is de minimis, and the cash flows coming from the energy sector are, sort of 3 times the size of the free cash flow coming from Microsoft. And, Microsoft is, 3 times the valuation in the index. So we are set in a particularly strange way for, a disinflationary environment sort of peaking in the S&P 500. And if we get an inflationary environment, underneath the surface, the index can churn a long time, not go very far as the sectors underlying sort of readjust to where cash flows are coming from.
yeah, I mean, a lot of things there. First of all, the good news is that unlike the '70s, it's now super easy with the click of a button, you can get exposure to the energy sector. We have ETFs, right? So,
Mm.
you can build whatever portfolio of sector ETFs you want. You don't have to just accept what's in the S&P 500. So that's really easy to do. Um, yeah.
Yeah, so you should empower yourself. And then, the awesome portfolio, it seems a little bit it's somewhat similar to the Talmud as well. I don't know if you've ever seen the, Talmud portfolio from several thousand years ago. I think it was a third businesses, a third gold, and a third was it cash? Something along those lines.
I don't know about this.
You
No.
know? Oh, yeah, it's like a 3,000-year-old portfolio, like, of a similar ilk. You've, um, dissected a
Yeah.
little more, add a little bit more,
Certainly in the same family as the permanent portfolio and,
right.
the idea of sort of global risk parity and, this sort of the idea being that we want to be diversified against regimes that are unfriendly to equities, right? I think that's the basic theme. Like there
Yep.
are other
Yep.
regimes that we can see through history and that are favorable for different asset classes, and you should be positioned to benefit from that and not be completely at the whims of whether you happen to be in a positive tailwind environment for equities, right?
Yep. Yep.
What about international equities?
Well, that's a great question because US stocks are super expensive and foreign stocks are really cheap. So, gee whiz, like you should definitely be overweighted to international stocks. And so, I actually got this question recently about the awesome portfolio. Like, somebody's like, why don't you have any international stocks in the awesome portfolio? I mean, think of the awesome portfolio as an index and you can depart from that index. I actually I have almost nothing in the way of US stocks. In fact, I am probably net short US stocks. In fact, I know I am. I'm net short US stocks. I have investments in India and Argentina and EM broadly. and Europe broadly. But I'm net short the US, which is kind of by design, but kind of not. But certainly, on valuations, like US stocks are just so overvalued relative to overseas. And one of the reasons that is because the US is the only country with big tech stocks, and big tech stocks have done the best. Europe doesn't have big tech stocks. So,
So let's explore some of those. I mean, a big bet in India and emerging markets. What is behind those? Any particular narrative you're following there?
well, India's really it's become sort of consensus in the last couple of months. Um, it's a great chart. It's been doing well. Modi is still popular in India. He's still an economic reformer. The demographics are good, unlike China. The thing about the emerging markets ETFs is that they're all heavily weighted towards China. Like the EM has like 35% in China or something like that. And China has the worst demographics of any EM country. No, not to mention all kinds of other bad stuff, So, I think with EM, you can't really generalize. Like, you could generalize in 2002. You could say, "I'm just gonna buy all emerging markets because they all have the same characteristics," but you can't do that today. You have to pick and choose in emerging markets. So,
And Argentina, you're bullish on.
yeah, I've been in Argentina for a while. As soon as I heard of Javier Milei, I bought Argentina. I had him picked to be the next president, and, that bet worked out, and that's been a great trade, so
Yeah, it seems to me that that model that he is doing a pretty darn good job of executing on, is kind of a sandbox for what the global economy is eventually going to need to reconcile with. Um, and when I was reading about his policies, it seemed to me that it was more likely that they're going to go through a period of extreme contraction and pain before they come out the other side with a clean balance sheet, a strong currency, healthy private sector, a healthy, contained public sector. It seems like the market has sort of looked right over um, that valley and into the healthy state that it, might emerge into in sort of 2 to 3 years. Did you have that intuition at all, or did you think this was going to be um, roses right from the start?
well, I mean, if you talk to anyone in Argentina, things are very painful right now. They've cut a massive amount of government employees, which has affected retail in particular, like, people just don't have money. Um So, I mean, look, Malay managed to balance the budget within a couple of months of taking office. I mean, it's just an incredible achievement. Um, I am it's funny because I have a subscriber in Miami who emailed me last week and he says, "Look, I have a friend um who knows Malay. Do you want me to ask him any questions?" And I said, "No, not really. You know, just does he think he can do it?" And he said, "Yes, he thinks he can do it." But he is up against the unions, he's up against Congress, like but he's been very successful so far. So
Yeah, it seems to me that, as this progresses, right, that, the government's spending is the private sector's income and the government's debt is the private sector's savings. And so, in order to sort of clean this up and balance the budget, there's a lot less income to go around in the short term. Again, huge long term benefits that the West has managed to avoid at all costs for the last 20, 25 years. Um, and, you know, I see this as coming out the other side if it can be fulfilled and if people can endure the short term, 2 or 3 years of pain, as being very positive. But it remains to be seen whether or not
let
the
me give you
public
one
will.
let me give you one quick statistic, right? So in the United States, the stock market cap is 170% of GDP. In Argentina, it's 9% of GDP,
Right.
right? Which is the lowest in the world. So if you think that if Malay is successful, and by the way, the mean is about 100% of GDP. If Malay is even moderately successful and gets the stock market to 50% of GDP, that's a five bagger, you know.
Yeah. No,
So
that's a really, really interesting statistic. That's very interesting. Um, any other themes besides India and Argentina that stand out in your portfolio, even if they're just tactical?
um no, not really. I would say that's about it. Yep.
And anything on the negative side that I mean, obviously private equity you mentioned, you don't have a lot of US exposure, so you would be sort of eschewing the semiconductors, eschewing the market cap side of things. Is that sort of the feel, and more getting that commodities and economies that are demographically have positive waves behind them along with
Yeah, pretty simple. Pretty
yeah.
simple. Yep.
Yeah, I mean, it's not that simple, and it's not that, sort of well adopted yet. I mean, something that, gets me excited about a trade setup, if you will, is you have, gold as an example. It's kinda like tobacco 1999. You've got, the ETF products across the board in pretty substantial reductions in AUM. And at the same time, you have breakouts to new highs of this, shiny metal. And so you really don't have, the average investor, and I mean the average investor, both retail and institutional, because institutional investors do not buy physical gold. They're going to buy gold largely through a proxy, like an exchange traded fund or product of some kind. So somebody's buying it. Obviously, we're seeing that through some central banks in the world. And then we had some news over the weekend and the appropriated funds of the Russians being, potentially sent over to the Ukrainians, which is an interesting set of circumstances, which is going to make everyone question the sovereignty of their assets and where they're held and what they're held in.
Oh yeah, that and that's, look, like, as gold is actually having a bad day today, as you know.
Mm.
I'm not terribly worried about it. I think that, central banks are going to continue to buy it, but that's not even my core thesis. My core thesis is really about the monetization. So,
So that's more of a pegging of the yield curve, 30s,
yep,
40s
yep,
type situation. You want
yep.
to walk us through that for the last for we'll wrap on that point. Does that
Yeah, so
make
this
sense?
happened in the 30s. The United States pegged the yield curve for the Fed. Long bond yields were held at 2% for a period of, I want to say, like 13 years or something like that. Um, and at the end of World War II, inflation ripped to like 18% or something like that. We had a big wave of inflation. Um, so this is going to be potentially much bigger. This is what we're talking about is the stuff that gold bugs talk about, like Weimar Germany or Zimbabwe or something like that. But we really could see a big developed economy like the US engage in full on debt monetization in order to keep interest rates at a manageable level. Like that actually could happen. Like you can see the future, it's coming. So,
Right. And with 1.1 trillion in the cost of the debt alone, it's going to be some interesting math to go through as we progress into the future.
yep.
All right. Awesome. Well, Jared, thank you for taking the time and covering the book for us. And as I said, you're the editor of the Daily Dirtnap, and you mentioned you're on Twitter. Where else can people find you? That's beyond the websites for the various um, properties we mentioned previously.
Twitter, I'm on at Daily Dirtnap, and the best place to find me is jareddillianmoney.com.
Perfect.
Brilliant. Jared, thanks so much for coming on, man.
Thanks. Great talk. Enjoyed talking to you guys.
Yeah, us too. Have a great one.
Sorry to interrupt, but I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.